The market just handed us another classic AI dip. NVIDIA is still the undisputed king, but its stock has been chopping sideways while the rest of the semiconductor complex got hit hard in July. Hedge funds took bruises. Capex anxiety flared. The usual chorus of AI bubble started singing again. Here's the part most investors miss. Every meaningful dip in this cycle has been bought aggressively, and the stocks that sit one or two layers downstream from NVIDIA have often led the next leg higher. I just finished digging through the latest numbers, and three names are flashing the same kind of early cycle setup NVIDIA itself showed a couple of years ago. I am buying heavy. These are not speculative lottery tickets. These are the picks and shovels companies that are already printing explosive growth while the market still prices them like the party is ending. Dips in this AI infrastructure wave do not last. They are invitations. The big opportunity is simple. Hyperscalers are still accelerating capital spending. Amazon, Microsoft, and Alphabet just raised full-year AI budgets again. Memory is in structural shortage. Custom silicon and advanced packaging demand is outrunning supply. The companies that feed that demand are generating the kind of sequential and year-over-year growth that used to belong only to NVIDIA. Let's start with the one that looks most like the next pure-play AI semiconductor winner, Broadcom. In its fiscal second quarter of 2026, Broadcom delivered $22.2 billion in revenue, up 48% year-over-year. AI semiconductor revenue alone hit $10.8 billion, a 143% surge. Operating margin reached a record 67%. Free cash flow came in at $10.3 billion, an eye-watering 46% of revenue. Management guided the current quarter's AI semiconductor revenue to $16 billion, which would be more than 200% growth year-over-year. They still see a path to $100 billion in annual AI revenue by fiscal 2027. This is not a company riding NVIDIA's coattails. Broadcom is designing custom AI accelerators for the same hyperscalers that buy NVIDIA GPUs, and it owns a huge piece of the high-speed networking that ties those GPUs together. Bookings for AI semiconductors exceeded $30 billion in a single quarter. The stock sold off with the broader group, but the underlying demand is accelerating, not fading. When the market finally accepts that custom silicon and AI networking are permanent growth engines, Broadcom's multiple can expand the same way NVIDIA's did once investors stopped debating whether AI was real. From Broadcom's custom silicon, we move to the memory that makes every AI cluster actually run: Micron technology. Micron just reported the kind of quarter that forces people to rewrite their models. Fiscal third quarter 2026 revenue exploded to $41.46 billion, up 346% from the year-ago period and 74% sequentially. Non-GAAP earnings per share hit 25.11 cents. Gross margin expanded to nearly 85%. Operating cash flow was $25.4 billion. Management guided the fourth quarter to roughly $50 billion in revenue, with gross margins around 86%. High bandwidth memory is the bottleneck of the entire AI build-out. Micron is shipping HBM4 in volume and locking in multi-year strategic customer agreements that give it visibility and pricing power most chip companies can only dream about. Cloud memory revenue alone was nearly $14 billion in the quarter. The stock has already been a massive winner this year, yet every time it pulls back, the numbers keep getting better. This is classic early cycle memory dynamics: tight supply, surging AI demand, and margins that expand faster than almost anyone models. History shows that once memory enters a supercycle, the leaders keep delivering upside surprises for longer than the market expects. Finally, the company that actually manufactures the most advanced chips for both NVIDIA and its competitors, Taiwan Semiconductor Manufacturing. SEMC's second quarter 2026 results were another reminder of its irreplaceable position. Revenue reached $40.2 billion, up nearly 34% year-over-year. Net income jumped 77%. Gross margin hit 67.7%. Advanced nodes 7 nanometer and below accounted for 77% of wafer revenue. Management guided the third quarter to between $44.6 billion and $45.8 billion, and raised full-year 2026 revenue growth guidance to slightly above 40% in US dollar terms. TSMC is the foundry for almost every cutting-edge AI accelerator on the planet. When NVIDIA, AMD, Broadcom, or the hyperscalers design a new chip, TSMC is usually the one that has to build it at scale. The 2-nanometer ramp is underway, CoWoS advanced packaging remains sold out, and AI-related demand is so strong that capacity utilization stays elevated even as the company adds enormous new capacity. The stock has been volatile with the broader semiconductor complex, but the fundamental trajectory is still upward and accelerating. Owning TSMC is the purest way to own the manufacturing bottleneck of the AI age. Put these three together, and you get a complete downstream AI stack. Broadcom for custom silicon and networking, Micron for the high-bandwidth memory that feeds the models, and TSMC for the advanced manufacturing that makes it all possible. Each one is posting growth rates and margin expansion that look a lot like NVIDIA's early AI years. Each one has been sold off in the recent panic. And each one is backed by hyperscaler spending that continues to rise rather than peak. The market is still debating whether the AI infrastructure boom can continue. The companies that supply the critical components are already answering that question with record revenue, expanding margins, and multi-year customer commitments. Dips in this cycle have repeatedly proven to be temporary. The investors who bought the previous ones are the ones sitting on the largest gains. I am buying heavy into these three. Position sizing still matters. Semiconductor stocks can swing hard, but the combination of explosive growth, structural demand, and compressed sentiment is exactly the setup that creates the next generation of multi-baggers. NVIDIA remains the leader. These three are the ones most likely to deliver the same kind of asymmetric upside from here. Do your own work, size according to your risk tolerance, and remember that even the strongest trends take time. But when the numbers look this strong and the narrative is still this fearful, history says the dip does not last.